In the last class, we were discussing about the functions or services provided by the primary market. So, what are all the functions of primary market do? So, under that, we have discussed various functions like transferring function. So, in today's session, we are going to discuss about mechanism of issuing instrument or methods of public issue of shares. So, if any company intends to raise capital by issuing shares to general public, then what are the way that this company or what are the options available to company for the purpose of raising capital? So please do remember we are discussing about capital market. Under capital market we are discussing about primary market. There are two types we are going to discuss under capital market. One is primary market and another one is secondary market. So primary market wherein the company issues shares to general public first time in its entire lifetime. It is called as primary. And once issued shares are traded or once issued shares, the transfer of ownership of already issued shares of a company is called as secondary market. And under secondary market, we are going to discuss various concepts like type of participants and various types of markets or various markets, including Bombay Stock Exchange, National Stock Exchange, etc. So these methods or these are the mechanisms available to any organization for the purpose of issuing shares in primary market. Fine, please remember what is primary market? Primary market is the market where company issues shares to general public first time in its entire life for the purpose of raising capital. Fine. So these are the mechanism available. Please note down everything. Very important for your SEM exam point of view also. So mechanism of issuing instruments or methods of public issue of shares. So these are the 9 methods I have enlisted here, and individual method we are going to discuss in detail because every mechanism or every method is very important from SEM point of view. So one is fixed price method, another one is book building method, another one is IPO, initial public offer, and public issue through prospectus, offer for sale, private placement method, rights issue. Already little bit we have discussed about private placement and rights issue of bonus shares, and stock option. Stock option, it is related to issuing shares to its own employees. It's called ESOPs or employees stock option. Now, in today's session, we are going to discuss about first method called fixed price method. So fixed price, the name itself suggests. So fixing of issue price. So fixed price, what is this price? So it is the price of a share which company intends to issue. At this price, company issues shares to general public, or the company intends to issue a share or single share at certain fixed rate. It is called fixed price. So for 2 marks, what is fixed price? So this is for 2 marks. You have to remember. This is for 2 marks. What do you mean by fixed price offer or fixed price method of issuing shares? So according to this method, the company fixes the issue price of the shares. The company, very important, these words. So issue price of the shares are determined by the company itself. And a question arises at this point of time. Then who else decides the issue price? Later we will discuss under other method. These method, it is on the certain methods are on the basis of issue price. Who fixes the price? So under fixed price method, a company itself fixes the issue price of the share, or that price, at that level of price, company intends to issue shares to an investor. Fine. So company fixes the issue price of the shares as it wishes, of course, and then advertises, and then it informs general public we are issuing share at this price. So as to the number of shares to be issued, again number of shares to be issued, it's always decided by the company. So the number of shares, if the company intends to raise 100 rupees as a capital by primary market, then company fixes rupee 1 each price, rupee 1 per share into 100 numbers. So 100 number of shares are being issued at the rate of rupee 1. This rate is fixed by the company itself. So under this method, according to this method, the company fixes the issue price. In this case, issue price is rupee 1 per share. So issue price of the share as it wishes, and then advertises as to the number of shares to be issued. Now, under this definition, on the basis of this definition, again for 2 marks, we are going to discuss two other concepts called under subscription and over subscription. See, in case if the company intends to raise 100 rupees, right? In our illustration, company intends to raise rupees 100 for its business purpose, and this 100 is called capital to the company. Now, if the company fixes the price at rupees 20 per share and 5 numbers, the company is issuing 5 shares at the rate of rupees 20. If an individual, excuse me, if an individual investor thinks that rupees 20 is too high for this company's share, ABC company. The company called ABC. This ABC company intends to raise capital of rupees 100 by issuing 5 numbers of equity shares at rupees 20 each. And an individual who is going to subscribe later, who intends to subscribe this company, thinks that rupee 20 is too high for this company's shares. So all the investors think in the same way, and the entire, only among 5 shares, only 3 shares are being, 3 numbers, 3 shares are being subscribed. So the capital raised by the company is rupees 20 into 3 shares, it is only 60. Now the company intends to raise capital of rupees 100, but eventually company succeed in raising capital of only rupees 60 because this price was too high, and an individual investor thinks that this issue price is too high. So only 3 members or 3 shares are being subscribed. So company could raise capital of only rupees 60 instead of rupees 100. So the rupees 60 is lesser than 100. It is called under subscription. For 2 marks, what do you mean by under subscription? If the price is so fixed by the company of the share is very high, in our example if it is 20 rupees, then the investor will naturally apply for less number of shares. See, company intends to issue 5 numbers, but eventually investors apply for only 3 number of shares. That is why company could raise only rupees 60 instead of rupees 100, which company intends to. Right? So naturally apply for less number of shares, and it is called as, it is cost under subscription of shares for 2 months. So very important. What do you mean by under subscription and what do you mean by over subscription? These two concepts are very important from some point of view, some exam point of view. Vice versa, on the other hand, if the shares are underpriced, see in our example, rupee 1 per share, but the company is too good to invest, company is going to do great business ahead. So company wants to issue shares at rupee 1 each. That if an investor looks at this price, issue price is rupee 1 only, then company gets or investors apply for 200 shares. But what happens here? Company wants only 100 rupees. Rupees 100 is enough for this company's business expansion. Now company wants to raise rupees 100 only, but they get the application for 200 shares for rupee 1 each. That's what here it is. If the shares are underpriced, very nominal, investors will apply for more number of shares, 200 in our example. It leads to oversubscription. It is called as oversubscription. Under subscription, company couldn't raise the capital which it intends to. But oversubscription, company's shares are oversubscribed because company is issuing only 100 shares, but company got the application for 200 shares. So this type of subscription is called as oversubscription. These two concepts are very important. Please do remember and please note down this. And in the next session, we are going to discuss about steps involved in issue of shares. Which are the steps issue of shares under fixed price method. So steps involved in issue of shares under fixed price method. We are going to discuss in detail in our next session. But these are the steps involved. Selection of merchant banker. Merchant banker is a banker who undertakes each and every process of issuing shares and raising capital. See, this company called ABC Limited, ABC company is not having enough time to issue shares and raise capital, etc., etc. So it outsources the entire process and it appoints a certain banker for the same purpose, and that banker is called as merchant banker. So this merchant banker undertakes each and every process of issuing shares and raising capital on behalf of the appointed company. Fine. So this is the first stage in issuing shares to general public. First thing is appointment of merchant banker. Then issue of prospectus. We are going to discuss in detail about prospectus. Prospectus is that document which invites public for the purpose of investing money in this company. So it is an invitation, it is an open invitation to general public for the purpose of subscription of shares. It is called prospectus. We will discuss in detail in next session. Then next step is application for shares. Then the term called minimum subscription is there. If company fails in subscription of its minimum capital to start or commence its business, it is called as minimum subscription. And under and over subscription we have already discussed. And allotment of shares to the who have applied for the shares, whoever the individual who applies for the shares, allotment of shares. Then calls on shares by the directors. If the shares are not totally subscribed, director may call for first call, second call, third call. We will discuss in next session. Then issue of share certificates. So these are the steps to be remembered under issue of shares under fixed price method. So in next session, we are going to discuss in detail about all these steps. Until then, please note down each and every point we have written on the green board. Thank you.